Hi, I'm Simon Lack with SL Advisors. Today I'm going to talk about the death of modern monetary theory, or MMT. So what is MMT? MMT is a theory that says that the government can never go bankrupt in its own currency. And because of that, the government can spend unlimited amounts of money. The only constraint is whether it causes inflation by using up more than the economy's productive capacity, by buying up more goods and services than the economy can actually deliver. For a very long time, we've been told to worry about the debt and the deficit, and we're borrowing too much money. So MMT really takes a very different look at that and says debt doesn't matter as long as you don't cause inflation. This theory has had a pretty good test in the last couple of years. In fact, government policy over the last 2 years since COVID broke out has looked a lot like MMT. We've borrowed trillions of dollars without any regard for what it's done to the deficit. And what we've got is inflation. If you look at this slide here on the debt buildup that we've had, our debt to GDP reached the levels of after World War II, and it's set to keep going up because of entitlements. There's no apparent cost to that, and there's really no political pressure to stop that. So MMT is really working with that. And what you saw through the COVID financial stimulus or huge fiscal spending was that the economy has been growing and people have been spending above the long-term trend, above the sustainable path. So MMT says it's fine unless you cause inflation. In fact, MMT argues that the Congressional Budget Office, or CBO, which is the nonpartisan group within Congress that's supposed to look at budget plans and decide what they'll do to the deficit, MMT believers say that the CBO should look at the inflationary impact of spending and that they should be the arbiters of any budget. And the problem with that is that the government already does that. In fact, before each of the spending bills, especially the $1.9 trillion that the Biden administration put out about a year ago, the White House economists felt it wouldn't be inflationary, Congress thought it wouldn't be inflationary, even the Federal Reserve thought it wouldn't be inflationary. The basic flaw in MMT is that spending should only be constrained if it looks like it will cause inflation. And yet we're not very good at forecasting inflation. And that's the flaw, that's the failure. That's why MMT has failed. What does this mean that investors should do? How are you supposed to deal with this? Our debt to GDP is on a one-way trip higher. There's very little prospect that that's going to change. I wrote a book several years ago called Bonds Are Not Forever, The Crisis Facing Fixed Income Investors. This was written several years before COVID, but the principles in that book remain true today, which is that as our indebtedness grows, we will have more tolerance for inflation and less tolerance for high rates. Because if you owe a lot of money, inflation is good for you as a borrower because it reduces the real cost of what you owe. And high interest rates make financing that debt expensive. And so I think what we're heading into is a period of time when we will tolerate higher inflation because we won't have the tolerance to raise interest rates to bring that down. So for you as an investor, what that means is that you should invest expecting inflation is more likely to be 3% or higher rather than the 2% that we've seen in the past. At SL Advisors, we manage investment products that are designed to protect investors and offer investors an upside to dealing with inflation. You can find out more on our website, sl-advisors.com. I'm Simon Lack with SL Advisors.